Picture this, it's a Tuesday morning. You're at work, half focused on a meeting, and you glance at your phone under the table. Your portfolio is down 14% since last week. Not gone, not wiped out, just down. Temporarily, probably. You know this. You've read the books, you've watched the videos, you understand that markets go up over time. And yet your chest tightens, your mouth goes dry, and something in the back of your head starts whispering, what if this is different? That whisper isn't stupidity, it isn't weakness, and it's definitely not a lack of financial education. It's something older than the stock market, older than money itself, and the investors who understand it, truly understand it, don't just survive market crashes, they get rich because of them. Let's go back to March 2020. COVID is spreading, governments are shutting down, and the S&P 500 loses 34% of its value in 33 days, the fastest crash in U.S. stock market history. Millions of Americans did the same thing. They opened their brokerage accounts, they watched the numbers fall, and then they sold. Not all of them, but enough. Between February and May of 2020, retail investors pulled over $326 billion out of mutual funds and ETFs, according to data from the Investment Company Institute. And then something brutal happened. Markets recovered. The S&P 500 finished 2020 up 16%. The investors who stayed in made money. The ones who sold, locked in their losses, and missed one of the fastest recoveries ever recorded. They weren't uninformed. Most of them had heard buy and hold. Most of them knew markets recover, but they sold anyway. Why? In 1979, two psychologists named Daniel Kahneman and Amos Tversky published a paper that quietly changed how the world understood human decision-making. It was called prospect theory, and what they found was simple, unsettling, and almost impossible to shake. Losing something hurts roughly twice as much as gaining the same thing feels good. Not a little more, twice as much. They ran experiments. They asked people to choose between guaranteed outcomes and risky ones, and they mapped exactly how the brain weighs wins versus losses. The data was consistent across different people, different cultures, different income levels. Winning $100 produces a certain amount of emotional satisfaction. Losing $100 produces almost double the emotional pain. The financial world calls this loss aversion, and it rewires how you see your portfolio in real time. Here's what this actually looks like in your brain during a market drop. You check your account, you see you're down $11,000 from your peak. That number, 11,000, isn't processed like a math problem. It's processed like a physical threat. The same neural circuits that fire when you feel physical danger light up when you see losses in your portfolio. Your amygdala, the part of your brain responsible for fear responses, activates. Cortisol floods your system, and suddenly you're not an investor making a rational decision. You're an animal trying to escape something that feels like it's hunting you. The rational part of your brain is still there. It's still saying, this is temporary, markets recover, you're not supposed to sell. But the emotional part of your brain is louder, and it's saying, do something, do it now, make the pain stop. This is why investment knowledge alone doesn't protect you, because the knowledge lives in one part of your brain and the panic lives in another. And when they fight, the panic usually wins, unless you've trained specifically for this. There's an investor named Mark. He's 38, lives in Austin, works in tech, started investing in 2017 with a moderate portfolio, broad index funds, a few individual stocks, nothing exotic. He read the books. He followed the philosophy, long-term thinking, don't time the market, stay the course. Then 2022 hit. The Nasdaq dropped 33% that year. Growth stocks got destroyed. His portfolio dropped by nearly a third, and Mark did what felt right. He shifted his money into cash and short-term bonds, just until things stabilized, he told himself. He waited for clarity. Clarity didn't come in a clean package. The market bounced, corrected, bounced again. There was never an obvious moment to get back in. By the time he re-entered in late 2023, he had missed a substantial portion of the recovery. Mark didn't panic because he was ignorant. He panicked because loss aversion worked exactly as designed. Here's the part that doesn't get talked about enough. Loss aversion isn't a character flaw. It's an evolutionary advantage applied in the wrong context. Think about where human psychology was shaped, not in brokerage accounts, not in quarterly earnings calls. It was shaped in environments where losses were genuinely catastrophic. If your tribe lost its food supply, you didn't get a second chance. If you missed the warning signs of a predator, that was it. In those environments, reacting fast to potential loss was survival. Caution wasn't fear, it was intelligence. The problem is that same wiring got dragged into a modern financial system where the rules are completely different. In nature, a 34% drop usually meant things were getting worse. In markets, a 34% drop has historically been one of the best buying opportunities a person can get. Your brain doesn't know the difference. It sees red numbers the same way it saw a shadow moving in the trees, and it tells you to run. Nobel Prize-winning economist Richard Thaler studied how loss aversion plays out in real portfolio behavior. He found something remarkable. Investors who checked their portfolios more frequently actually earned lower returns, not because of fees, not because of strategy, but because frequent checking exposed them to more small losses, which triggered more emotional reactions, which led to more bad decisions. Investors who checked their portfolios once a year significantly outperformed investors who checked daily, even with identical assets. Same stocks, same funds, different behavior, completely different results. The act of watching your portfolio too closely was literally making people poorer. There's another layer here that almost nobody talks about. Loss aversion doesn't just make you sell at the wrong time, it makes you avoid the right risks entirely. Imagine two scenarios. In scenario 1, you're given $1,000 and then offered a chance to either keep it guaranteed or flip a coin. Heads, you get an extra 1,000. Tails, you lose the original 1,000. Most people take the guaranteed money. In scenario 2, you start with $2,000 and you're offered a choice. Keep all of it guaranteed or flip a coin. Heads, you keep everything. Tails, you lose 1,000. Mathematically, these scenarios are identical. The expected value is exactly the same. But most people choose differently in each scenario. In the second scenario, they're more willing to gamble because now they're framing it as avoiding a loss rather than chasing a gain. This is called the framing effect, and it's why loss aversion doesn't just hurt you during crashes. It shapes every investment decision you make, often without you realizing it. The investor who refuses to put money in equities because, what if I lose it? That's loss aversion. The person who holds cash for 3 years, waiting for the right time, loss aversion. The one who sells their best performing asset to lock in the gains before the market can take them away, still loss aversion, just wearing a different mask. So what actually separates investors who stay calm during crashes from the ones who sell at the bottom? It's not confidence, it's not bravery, and it's not that they don't feel the fear. Research from behavioral finance at the University of California found that even experienced, professional investors experience the same emotional response to losses as retail investors. The fear is the same. The cortisol spike is the same. The amygdala response is the same. The difference is structural. The investors who survive and profit during crashes have built systems around their decisions that remove the human variable at the worst possible moment. They made their choices before the fear arrived. Warren Buffett's letters to Berkshire shareholders go back to 1965, and across 6 decades of those letters, one theme appears more than almost any other. The market is designed to transfer money from the impatient to the patient, not because patient investors are smarter, because impatient investors are responding to emotional signals that lead them to move exactly when they should be still. Here's a number that most people find shocking. J.P. Morgan published a study looking at the S&P 500's performance between 2002 and 2022, a 20-year window that included 2 massive crashes, 2008 and 2020. If you stayed fully invested for the entire 20 years, your annualized return was approximately 9.8%. Solid, compounding beautifully. But if you missed just the 10 best days of that entire 20-year period, 10 days out of roughly 5,000 trading days, your return dropped to 5.6%. And here's the part that lands like a punch. 6 of those 10 best days happened within 2 weeks of the 10 worst days. The biggest rebounds almost always come immediately after the biggest crashes, which means that the investors who sell during the crash, the ones who are responding to loss aversion exactly as their biology intended, are the ones who most often miss the recovery. They take the loss and then they miss the gain, twice. So what do you actually do with this? Knowing about loss aversion doesn't make it disappear. The fear is still real. The instinct is still there. But there are specific, practical things that high-retention investors do differently, not because they're immune to the emotion, but because they've built their system around it. The first is pre-commitment. They decide in advance and in writing what they will do during a crash before the crash happens. not I'll probably stay in, something specific. If the market drops 20%, I will buy more, written down, stored somewhere, because a decision made in a calm state protects you from a decision made in a panic state. The second is reframing the loss. Professional investors don't look at a portfolio drop as losing money. They look at it as assets on sale. The same dollar buys more shares at lower prices. This isn't just a motivational reframe, it's arithmetically accurate, but it requires practice to make it feel true, not just intellectually understood. The third is removing the feedback loop. Toller's research wasn't just interesting, it was actionable. If frequent checking produces worse returns, then checking less frequently is itself an investment strategy. Automating contributions, setting calendar reminders to review once a quarter, removing brokerage apps from the home screen of your phone. These aren't small things, they directly affect performance. Here's the final thought. Most investors spend their time trying to find the right stocks, the right funds, the right timing. They study charts and read earnings reports and argue on forums about whether a company is undervalued. And all of that matters to a degree. But Kahneman's research, the work that eventually won him the Nobel Prize in Economics, suggested something uncomfortable. The biggest variable in investment performance isn't asset selection, it isn't timing, it isn't even fees. It's behavior. Specifically, what you do in the moments when your brain is telling you to act, and acting is exactly the wrong thing to do. The investors who outperform over time aren't necessarily smarter. They've just solved a problem most people don't even realize they have. They've looked at their own psychology honestly, at the fear, the instinct, the wiring, and built a system that doesn't rely on their emotions making good decisions in bad moments. The market will fall again, it always does, and when it does, most investors will feel exactly what you felt before, that tightening in the chest, that whisper in the back of the head. The question isn't whether you'll feel it. The question is whether you've decided, in advance, right now, while the market is calm, what you're going to do when it arrives. Because that decision, made today, might be worth more than every stock pick you'll ever make.